Good day, everybody. Let's get started. My name is Emma Kilduff. I'm one of the co-founders of the Fortia group. I'm wearing a tie for the first time in 3 years. I'm at a conference in London, so excuse the maybe over-the-top formal attire for this audience. Although the novelty factor is quite cool to suddenly wear a suit and a tie again. Welcome everybody. Looking forward to getting stuck into today's topic, which is how private equity firms value businesses, and as much as possible we'll focus on e-commerce businesses. So let's jump in. First of all, I want to thank three of our partners of our monthly webinar series that we started in October last year. The first is Factored Quality, run by Prince out of New York, really strong firm that audits the supply chain and manufacturers. So for brands or aggregators, please do reach out to Prince and colleagues to understand what he offers. The second is the legal side of things, again, both for sellers and for buyers. Mark is really strong on IP, which is critical, particularly for brands that are gearing up to sell. It's important to have all the ducks in a row from an IP, patent, trademark perspective. So please reach out to Mark if you have any questions around that. And then finally, Dan, who runs the Titan Network, one of the best sort of mastermind type communities of Amazon sellers. A big part of what we do within the e-commerce world is help interesting sellers obviously get exit ready and ultimately sell. So we're glad to be working with Dan and colleagues. All our webinar topics are demand driven, i.e. we survey the audience and ask what topics they want. We don't just come up with topics and push them upon our clients and prospects. In the survey we did, I think it was back in July, this was a topic that was asked, we were asked to put on: how do PE firms value e-commerce businesses? There's probably a better understanding as to how e-commerce aggregators value e-commerce businesses, but this topic is less understood by a lot of e-commerce founders and entrepreneurs that we speak to, so hence the topic. A lot of PE firms are shy about talking about valuation publicly, so we don't necessarily have 4 PE firms, but we have the next best thing. We have 4 people who are proxies for what's happening at PE firms, and that's Stephanie, Scott, Sri, and Dan. And I've seen the materials; they're very thoughtful and high quality. So we'll get a really good look into the world of how PE thinks about valuing companies. Before we jump in, we want to talk to you about a new webinar format type we're launching in November. And it's the first of a kind Shark Tank type webinar. We're calling it From a Buyer Perspective. It's an early look. So about 22 of our engagements at the moment are in our Exit Ready program, i.e. 10 or so entrepreneurs have entrusted us to gear them up for a potential exit for a sale. And they're coming down the line in 2023 or beyond. And this webinar on November 10th will showcase who those buyers are, who those companies are, in order to give buyers an early look of future deal flow. So it's a really unique opportunity for the M&A folks at aggregators, private equity, corporate venturing to learn about 10 deals that'll come to market in 2023. If you'd like to register for that, please do so on our website. It's buyer only, and we'll be very strict on that. And every buyer will have to have signed our mutual NDA. So the agenda for today's webinar, first of all, I'm going to try and set the scene and tee up the 4 speakers. Then they're under serious pressure to deliver 4 TED type talks. And TED talks are one of my favorite things in life to listen to, and we challenge the speakers to give engaging talks for the audience, and then we'll have lots of time for discussion and Q&A from all of you. Please do submit questions via the Q&A button on Zoom as we go through today's webinar, not just at the end. And please don't submit them via the chat. It's much easier for us to manage via the Q&A button. So let's jump in. So let's try and set the scene. Why is it important that we talk about private equity? Well, in our view, at a high level, there's 3 key components needed to get a good exit. The first is you've got to hire good people. The second is you've got to apply a proper granular diligent process. And the third is you've got to approach all of the most relevant quality purchasers. I'll briefly touch on 1 and 2 in a moment, and then I'll do a deeper dive into 3 to set up my fellow panelists. So from a people perspective, we haven't shown these slides publicly Just the team here at the Fortia Group, I'm ex-Morgan Stanley Credit Suisse. What we're trying to build is the Morgan Stanley for e-commerce, to give a flavor of the level of experience that we have in the core team and the advisors. We've advised, we've 60 years collective experience. We've advised on over $80 billion of transactions. Way back, I was involved in the sale of Debenhams, a retail store chain here in the UK, back in 2003. I led and worked on one of the biggest IPOs in history, the Glencore IPO, $11 billion IPO. My colleague David has worked on a lot of e-commerce specific deals. One of our advisors set up and sold Real.de to Europe's biggest retailer. So we have a lot of strong corporate finance experience that you don't necessarily see in a typical broker. And you don't, for those entrepreneurs that sell their own companies, it's sort of, it's sort of madness when if it's your first rodeo to going to market and not having, the 60 years of experience to ultimately get you the best deal. From an e-commerce perspective, to give you a flavor as to what we're up to, we have done some advice to credit funds who are looking to invest in aggregators and want us to help them think about valuation at the brand level. I'm advisor to Swiftline, which is a company that bought Yardline, that spun out of our friends at Thrasio. Our investment syndicate, the Fortia Group, is an investor in the Hedgehog Group, the leading buyer of distressed DTC brands. Really fascinating business. We sold a brand for the founder of Spartan Brands. After he sold it, he set up Spartan, which is a new incubation machine going incredibly well. We've helped him obtain good credit terms. We came up with the idea with Mini Aster at Romania for an aggregator called Brandslandia Group. That's in its very early stages, looks at deals on Eastern European markets, which very few, if any, are doing. We're currently advising a US aggregator on its mergers of aggregators. MOA is a term we coined back at Prosper in March. There's going to be a lot more of that given for various reasons, which we might delve into. And then obviously sell side M&A is our core offering. We have 12 clients in our Exit Ready program, most of whom will present on that Shark Tank type webinar, and we have 7 or so live exits at the moment. So we're have good background in M&A, corporate finance, and we're very much live in the e-commerce space. So people is important. That's the first P. The second is process. I'm not going to go into detail on this slide, but what we're trying to bring that's different to the market is a Morgan Stanley level of Wall Street experience to how to run a process on the sell side. We don't consider ourselves a business broker. We want to be at really high standard, Morgan Stanley level of standard in the space. So let's jump into 3 then. The third P is purchasers. We've had people, process, and purchase is obviously key to any deal. The e-commerce entrepreneurs listening to this webinar live, or indeed on the recording on YouTube, need to understand that their asset, their baby that they build, should be brought to all relevant targets, not just an FBA aggregator or DCC aggregator. If it's big enough, if it's over typically 10 million revenue, you've earned the right to pitch to all of these types of buyers, and you should do so if you want to get the best terms. So what do we mean by private equity? At a very high level, I'll give you some observations, and in a few minutes we'll pass on to my colleagues. From a capital perspective, it's important to note that there's a huge amount of dry powder, as in they've got a lot of capital to put to work, primarily due to the low interest rates over the last 10 or so years since the credit crunch in 2008. And I have a good chart to bring that to life in a moment. From a size perspective, I mentioned that typically small and medium-sized PE firms will look at brands that have at least 10 million in revenue. Below that, it's really just too small for them. However, some of the portfolio companies of a PE firm might want to do a smaller bolt-on. So if a PE firm buys a company for 30 million in the pet space, they may well look at buying a bolt-on for strategic reasons that is smaller than 10 million. Something for the more ambitious entrepreneurs to think about is them going out and getting backing from PE firms to do a roll-up strategy in their category, effectively becoming a mini aggregator. So if there's a large pet brand or baby brand, why shouldn't those founders be backed by private equity to do roll-ups, given they're obviously proven operators and know their category really well? We'd love to speak to folks who wanted to brainstorm on that. From a channel perspective, certainly 2 to 3 years ago or more, PE firms thought that brands selling 100% through Amazon was were incredibly risky because of the channel risk, because of the concentration risk of relying on Amazon. And we all know that, you know, it's difficult to rely on Amazon. They can change things overnight. That started to change a little bit. I think PE are becoming a little bit more acceptable with sort of Amazon only or Amazon majority businesses. But there is definitely a preference for a business that has at least started to prove itself on an omni-channel basis. From a deal structure perspective, whereas DTC aggregators or FB aggregators typically want 100% acquisitions, the private equity firms are more flexible. Some of them do minority investments, i.e. 25%, some do majority, it could be, for example, 75%, and some of them are looking to take 100%. So there's maybe more flexibility than other types of buyers there. Timeline, much slower than aggregators. Aggregators moved incredibly fast. They've definitely slowed down to do more comprehensive due diligence in the last maybe six or so months, but private equity take longer. From a valuation perspective, interesting chart in a few moments' time, they generally pay higher multiples than aggregators. And the decline in valuations we've seen since the correction of April, May this year has definitely increased the quantum of inbounds we're getting from PE or sniffing around in the space. From a people perspective, PE usually require founders to stay on for 2 to 3 years. I think looking back, a lot of aggregators will put their hands up and say they made a mistake by not retaining a lot of the folks that set up the brands, that they let them go too early, too soon. And I think you'll see more sort of private equity type tactics from aggregators as we go forward. So just jump into a few of those points. I'll double click on a few points. So the first is, the dry powder, awesome chart, which shows how much capital is on the sidelines with private equity firms worldwide. And the aggregators themselves have a lot of private equity, a lot of firepower on the sidelines, as do corporates on their balance sheets, or certainly the most successful corporates, or corporates that are doing well at the moment. So there's no shortage of money to be put to work. They absolutely are being very selective. Good isn't good enough, or average isn't good enough anymore. Good brands, really tough to sell at the moment. The buyers are hunting for diamonds, which means growing revenue, large revenue, growing revenue, great net margin trajectory, and a few other things which we'll touch on as we go through today's webinar. For anyone that doesn't know, private equity pay higher multiples than aggregators, full stop. These are data points which show the Ebitda valuations in the States and here in Europe over a long period of time. These charts will go up to 2021. Clearly, since the correction, there will be a downward shift in the charts. However, it still proves the point, like for FBA only businesses, the typical range today is 2 to 5 times STE or Ebitda. For DTC, it's much wider because there's a lot of distress and issues post iOS changes. So we are saying it's 2x to 9x. But clearly, these multiples are above those ranges. And so again, for entrepreneurs that have worked really hard, built a great brand, if you've got over 10 million revenue, you need to be putting yourselves out to PE firms as part of an exit process. So what do they look for? Found really interesting research from the Journal of Corporate Finance that surveyed hundreds of PE firms asking them what do they look for in businesses, what are their requirements? And number one was revenue growth. To be honest, I would have thought that management team or track record would have been higher. And I think if this was asked today in this tough economic environment, I think profitability would probably move up. I think people might sacrifice revenue growth a little bit in order to have better net margins and profitability. Cash is king as we go into a tough economic environment and recession. But I think it's helpful to sort of again, for the entrepreneurs in the room or listening to this on the recording to really understand their requirements. I'm happy to send this paper as part of the follow-up for those that want to do a deeper dive. From a private equity perspective, here at the Fortia Group, we have experience before starting the Fortia Group selling to private equity, and our best example at the Fortia Group is selling BeLive, a supplements business, to a German private equity firm called Finex. It had a portfolio company called Mat for Life, which was strong in DTC, but had little to no experience in FBA. And so it saw the strategic rationale as being the ability to capture a good business, but also know-how on Amazon to help its DTC business, get onto Amazon and vice versa. So we have relevant experience and look forward to working with entrepreneurs to ultimately get them the best deal, whether it's to an aggregator, private equity firm, or indeed a corporate. Okay, thank you for listening. Now let's jump into the first of our 4 panelists. I'll ask Daniel, please, to unmute yourself and look forward to your talk.
All right, so great to be with you. And yeah, I think the things I'll be talking about are very relevant to what you just heard from Emmett. So I don't know if you can move forward one slide. Yeah, so today what I'm going to be talking about is providing some insight into how a growing segment of the PE market is evaluating businesses, essentially by looking to the customer data and analyzing it in the right way. And then I think this will also be relevant for getting some sense for what we're seeing, at least for a few of the analyses that we've done about kind of overall market conditions. If you move forward a slide. A little bit about kind of me and some of my background. I'm an assistant professor of marketing, so I've written a number of papers that have won a bunch of awards, kind of tying customer-based activity to overall corporate valuation. I've also co-founded 2 companies. I co-founded a company called Zodiac, a predictive analytics software as a service firm that used some of my statistical models along with Wharton professor Peter Fader. This was a marketing company, so we primarily help marketing departments make better tactical acquisition retention decisions. We grew it and sold it to Nike in March of 2018, and then subsequently co-founded Theta. Theta, I think, is much more relevant for this audience. About half of our revenue comes from private equity. These are just some of the brands that we've been allowed to share that we've done work with. As you can see, there are now a number of corporates because the non-compete with Nike has expired, but there are also a number of good private equity firms that we've worked with too. And again, the main thing that we focus on is applying this customer value lens I'm going to talk about shortly. If you can move forward a slide. So at a high level, when you think about the PE diligence process, obviously they're all going to have their standard, valuation spreadsheets, whether they're looking at multiples of revenue, multiples of Ebitda, or laying out all the free cash flows through some sort of a DCF model. And what's interesting is oftentimes the companies themselves that are being evaluated, they'll put in their data room, especially kind of the later stages of the diligence process, customer data. Oftentimes it's the full transaction data set that they have along with the CRM data. Sometimes it's summaries of that. And the fundamental claim that I'd make is, let's use that. There's information there and it can help us understand whether an investment can be promising or not. And so increasingly, the investors have been asking for this data, and we've been helping them incorporate that into their diligence process. So if you just move forward one. So essentially, the way you can think about it is we're kind of taking that standard framework, but we're essentially exploiting an accounting identity that revenue has to come from customers who are making purchases, and there's some spend associated with the purchases. And we'll just apply statistical models to forecast the future evolution of customer adoption, the retention of existing customers, order frequency, spend, all the way down to the individual level, and then aggregate it up to get our enlightened revenue forecast. If you can move forward one slide. So yeah, just to kind of very quickly describe what we do, we'll kind of take whatever data is available. It could be internal data, again, transaction logs, CRM data. It could be aggregated summaries thereof. So oftentimes we'll have cohort triangles that represent, for each of your different acquisition cohorts over each of the time points, how many customers are active, how much revenue you're getting, et cetera, et cetera. And if you can move forward, just one. What we're going to do is we're going to run that through a series of statistical models. So I'm formerly a statistician by training. I've got a PhD in statistics. And again, it's going to be for those different behavioral processes that bring about revenue. If you can move forward one more. And what we're going to do is we're going to take those models, and what they'll give us is essentially a prediction for what every customer will do. So you could think of them as the rows in every single time point. And so if we kind of had that data and we had customer acquisition costs and we had margin data, ideally at the transaction level, we can get things like customer lifetime value, CLV to CAC, and all the rest of it at the segment level, even at the individual customer level. But then we can also use that same sort of a model to get future revenue projections and have that drive a DCF model. If you can move forward one slide. This is just one super quick example. So Warby Parker, they had done their public offering in September of last year, so about a year ago. And we actually did our analysis of them before they put out their reference price. So we were really flying blind. They had put some very good data in their filing. We ended up concluding that their fair value was about $22 a share. They came in at 54. And maybe if you could just move forward one. What we had done was we had run our analysis off of all of the public data that they provided in their S1 filing, the filing that they put in before their DPO. And so again, we're going to train our model here. It's kind of the ultimate stress test because we're very far from having all the granular data. We just had whatever aggregated summaries they put into the IPO prospectus. And if you can move forward one. We then ran that through the same sort of statistical models. We validated those models to ensure that they capture all the variation that's worth capturing. And we concluded things like, what is their CLV to CAC? What is their implied marketing return on investment? How are they doing in terms of first purchase profitability? And if you can move forward one. And what we concluded was, again, first that their valuation was something like 22. Our estimate of their fair valuation was 22. So when they began trading at 54, we were a bit cautious on the valuation, even though we actually thought their underlying economics were pretty good. And I'll have a little bit more to say about how things have evolved since then very shortly. So if you just move forward a slide. So again, this is just a sample of the sort of data that they provided. Again, in a PE diligence setting, we'll typically get much richer data than this, but the one I really want to call your attention to is the one in the top right. This is giving us data about revenue retention by customer cohort. And so we can see for each of the different kind of cohorts of customers that made their very first purchase in different years, how those customers have monetized over 1 year, 2 years, 3 years, 4 years. And this really helps us be able to identify the sort of statistical model that we would use to understand what it all means for customer lifetime value. If you move forward a slide. So what ended up happening? We put out our analysis, and again, we were somewhat gloomy on the valuation. If it bleeds, it leads. So obviously ended up getting a lot more media attention than if we concluded that their valuation was justified. Their valuation has fallen significantly since then, including before all the recent turmoil that we've been going through. But if we kind of roll forward even further, if you could just move forward a slide. What you'd see is that they actually, and maybe just move forward one. So again, we came in at 22, they came down to 22, and then they subsequently plummeted way below 22. So they traded almost as low as 11, so about half of what we had originally estimated. And so in August of this year, we said, maybe we should take a second look. And so we went back in, retrained our model on all of the newly available data. And if you just move forward one, what we found was that our revised fair valuation estimate was about 20. So a little bit lower. Even when we kind of stress tested our assumptions, we were still coming in north of 17. And so 11 seemed low. But I think this is also indicative of a lot of what Emmett had been alluding to, that valuations have been coming down, but also they've been coming down to the point that whereas we had been almost laughed out of the room, back when they were trading at 54, now we're actually coming out bullish. And so it could be, again, if we're correct, that there's room for upside in terms of valuations here. If you can move forward a slide. So that's pretty much it for me. I think that this sort of methodology can be very useful for you. Obviously, we'd love to speak with you, as you could see, both if you're trying to set yourself up for success to look good as part of an acquisition process. I think that this sort of methodology, it can both help you make the decisions that you want to make to help the metrics look better, but also how you can kind of best set yourself up for success and put the right measures out there that won't expose your flank, so to speak. So thanks so much, and looking forward to questions at the end.
Dan, thank you so much. I've admired your work and your colleagues' work since we met many years ago with my Eagle Alpha hat on. We've had a question into the Q&A box, and I was thinking about the same question myself. Have you bought shares in Warby Parker now in the last few months?
We have a pretty strict policy of not investing in the companies that we analyze. And I had this experience with Wayfair where we had put out this academic paper, and we were bearish on Wayfair, and the stock went down, and the CEO was very upset with us, and he had some affiliations with Wharton, and they were accusing us of having been paid by a short seller and just talking our book. And as an academic, if we were purely non-academic, I think it'd be one thing, but as an academic, that sort of research integrity is extremely important. So no positions, but not because we don't think that they're attractive.
Yeah, very good. Thank you very much, Dan. Great. Up next, we have Sri, who's a managing partner and founder of Athena. Over to you, Sri.
Sure. Thanks, Amit. Hi, everyone. My name is Sri Malladi. I'm with Athena Consulting Partners, and we work with companies both on the buy side and on the sell side. On the buy side, helping companies to find, source, diligence, value, structure, and close transactions. And on the sell side, helping companies to position themselves for the market, building their valuations, finding the right kind of buyers to go to. And excited to speak to you all about this topic. Next slide, Amit. So before we go into the valuation concepts, just a couple of things to touch on, which are very important, which will come up. One is Ebitda, which for most private equity companies is a close proxy for cash flow. It's not perfect, but it's close. It's a simple calculation, starting off with revenue, let's say $100, back off the cost of sales, getting to gross profit, back off your general and administrative expenses, also called as OPEX, and then depreciation, getting you to operating income of $17, say. And then you add back D&A, which is a non-cash expense, to get to an EBITDA, in this case, of $20. So this metric is an important one in terms of valuation. The second distinction I'd like to make, and sometimes it confuses businesses, is the enterprise versus equity value. Enterprise value is the entire value of the firm that is by the debt investors as well as equity. And the equity value is what the founder or the entrepreneur gets when the company sells. Next slide. So two approaches I'll talk about. The first is called the comparables approach. And this, I always like to think of it in terms of a simple principle. And this is very much like a real estate agent would do when they're trying to sell or buy a home, right? You try to find companies that are similar to the business, and then find some metrics that will help you to make that decision. And then you look at how do those companies trade in comparison with your business. So for an example, you might look at the product segment, let's say office supplies. You might look at the size, the revenue range, geography, and then you collect information. How have companies in these kind of comparables sold and transacted at? And then you calculate a median or a mean EV, which is enterprise value to revenue multiple, or an enterprise value to an EBITDA multiple, as an example, and then apply it to the specific company. So if the company is doing, let's say, a revenue of $20 million, and the comparable valuation suggests a 5 times multiple, that gets you to 100 million valuation for the business in question, the target. Next slide. So a couple of kind of pros and cons. One is this kind of is a good market check. It actually tells you what the market itself is willing to pay for businesses like yours. The challenge is it's challenging to come up with apples to apples comparables. And it doesn't always sometimes tell the full story, especially if your company has a very strong growth trajectory, but the comparables don't. This number alone will not tell the full story. A couple of nuances here. One is private equity investors for e-commerce businesses or any industry really will look at a couple of metrics. One is the adjusted revenue and the adjusted EBITDA. And these are basically them trying to normalize the company's EBITDA and cash flow so that they can look at companies on an apples to apples basis. So as an example, I was working with a business that was doing basically selling home products. And when COVID hit, they were selling these gloves that were used for cleaning your kitchen and so on. And their sales went up through the roof. But when a PE looks at it today, they will back out a good chunk of that because that's expected to be non-occurring. And similarly, there are adjustments they would make to Ebitda, which is like owners' expenses being above or below market, personal expenses flowing through. So it's extremely important to have a good grip on adjusted revenue and Ebitda. And then in terms of multiples, I've seen broad ranges of 1x to 5x revenue, 4 to 20 times Ebitda. And the thing to know is that this selection of these comparables is much more of an art than a science. There are a ton of factors that impact what multiple to apply, what category you're in, what your channel is, which Emmett touched on, your customer concentration. Too much customer concentration is bad, whether it's B2B, B2C, and how kind of stable your revenue and your Ebitda is. Next slide. So we talked about comparables. Now the next approach is the leveraged buyout approach. And the principle here is debt is always a cheaper form to buy a business than equity. And the private equity investor will look to increase the value of the business by using basically primarily 3 levers. The first is increase the Ebitda of the business. The second is to increase the valuation multiple. And the third is to pay down debt over time. So just as an example, if you look at a company, let's say let's say it's about a $10 million Ebitda in year 1, and when the PE is buying it, and they buy it for a 9x multiple, they're paying $90 million for it. Let's say they put 30% equity and 70% debt. So the equity value of the PE is 27 million. Fast forward to year 5. Let's say they've been able to grow the Ebitda from 10 to 13 million. And let's say that they've made some changes to the business. Maybe they have reduced concentration. Maybe they have improved margins. So the business might sell for, let's say, 143 million, which is 11 times 13. And they've also used the cash flow from the business during the 5 years to pay down debt. So debts come down from 70% to 30%. Just by virtue of doing these 3 things, the internal rate of return, which is the key metric that PE investors are looking for, ends up being close to 40%. They're looking for numbers around 20, 25% is healthy. So it's kind of important to look at it from their lens. What exactly are they trying to do? And it all comes down to cash and all comes down to paying down debt and increasing Ebitda over time. Next slide. So just some takeaways from how do you look at it from trying to maximize the value of your business if you're looking to sell. And I think the main comment I would make is that to maximize the value for your business, minimize the risk, both financial and execution, for the PE sponsor. So the better you can demonstrate to them that the business is high growth, but also low risk, the higher the valuation they'll give to your business. And I'll bucket these takeaways into 3 main kind of segments. The first is sell-side readiness basics. Often I find that businesses are not ready before they start talking to PE, and that's a big mistake. You want to be sure that you have your story, your growth story, your strategy, what customers you're targeting, how you're getting to them. All of those you need to button down. The second is to have a very clear grip on your historical financials and your projections. The third is to have documented contracts with your customers if there are big customers and your vendors. And then the fourth in the first bucket is the pipeline, making sure that you can demonstrate a customer and a revenue pipeline that will get you to your projections. That was the first bucket. The second is to generate predictable revenue growth. And by this, it goes back to reducing risk. If you can show that you have or you are migrating your customers from a one-time purchase to a recurring revenue stream. So for example, I was working with an e-commerce business that was selling health food supplements, and they transitioned a sizable chunk of their customers from making one-time purchases to putting them on like a monthly plan where they would ship them supplements every month. Second is repeat purchases, getting your customers to start small and grow big. And then finally, to to reduce your channel over dependency. And I saw a good example of this with the Apple update when they made their kind of their opt-ins for marketing, and one of the company I was working with, their revenue fell off a cliff because they were over reliant on that channel to get to their customers. The third and the last bucket is to increase the free cash flow. And the first thing I would say is to do a P&L audit, look at your entire P&L and identify the main numbers and try to optimize them over time. And for e-commerce businesses, this typically ends up being your marketing spend, which is your customer acquisition cost. And the second and the third end up being your like your cost of goods sold, your supply chain, and your OpEx. So if you can get a handle on these three areas, you'll be much more prepared for a sale if you're looking to speak to PE. Thank you.
Thank you, Sri, and thank you for succinctly explaining how PE firms look at it from a debt perspective. It's important that for the entrepreneurs on the call that the cash flow is really key for private equity. You know, there needs to be a net margin. You know, there needs to be cash flow there to get private equity firms to take a look. So it's you know, there's a minimum required of size, not just on a revenue perspective, but also net margin and cash perspective. Okay, thank you, Sri. Next up, we invite Stephanie Bond, who has worked at some family office type private equity firms in the past, and look forward to your perspective. Stephanie, over to you.
Thanks, Emmett.
Yeah, great.
Take off mute. It's good to be here. I'm going to zoom out a little bit if we want to go to the first slide. You know, first up, I want to sort of touch on the reasons. That's the last slide, I think. Maybe skip back to the beginning. Anyway, touch on some of the reasons that you might be looking for a private equity partner, and that I think will help frame the discussion around the investment process and valuation. I think we just need to go back one more slide. At the heart of it, I'll just keep talking and you can find the first slide. At the heart of it, it's often that you need a partner to help you move through a new phase of development for your business. And private equity can help you get there, right? They've got resources, relationships, and scar tissue that you can really benefit from. And assuming that you as a founder are looking to stay on, you really need to think about this like a marriage and understand what you're going to get out of the transaction. You know, also appreciate that if you're retaining equity in the company, think through how much value can be created during that hold period. Often there's more wealth created on that second transaction when the PE firm exits, which comes down to sort of the Ebitda growth, organic and through acquisition, the exit multiple expansion, the debt pay down that Sri referenced. I think if we go back still one more slide. Anyway, so it might be that one firm offers you a higher enterprise valuation today, you know, but that might not be the best option. If there's another firm that has a long-term vision that's more aligned with your own, and you believe that you can ultimately create more value with that firm, then that might be the better option. All right, so in general for private equity, we're talking about control positions in established companies. There are exceptions, but you know, versus venture, right, which focuses more on minority stakes in smaller companies that have really tremendous growth opportunities. And while private equity and venture both target overall fund returns of 20 to 25%, the expectations for individual companies are quite different. For venture, that overall fund return often hinges on kind of one, you know, the top portfolio companies, whereas private equity is looking for a much more even distribution across the portfolio. They don't want zeros. They really want to protect the principal risk on the buy, so they don't have the luxury of taking bigger bets. You know, generally, I think of venture as looking at valuation through the lens of what happens if everything goes right in the future, whereas private equity is more focused on what the company is worth today. That's not to say that, you know, private equity isn't thinking about future growth opportunities, but the emphasis on current value, I think, informs a more sober view of valuation. So you just want to be aware of that. We can go to the next slide. So as I said, private equity is more focused on hitting singles and doubles. Another important distinction is that private equity normally uses leverage, right, as Sri was talking about, which helps amplify returns. And that further places attention on that Ebitda and cash flow generation because you need to pay that down, right? That debt needs to be serviced. It also means that you have another party at the table, which is your lenders, right? That's something, again, to keep in mind. On this page, I've asterisked bigger checks because I think that that distinction between private equity and venture has definitely blurred in recent years. But sort of taking all these factors into consideration, bottom line, there really needs to be strong conviction from private equity around new investments. So if you're looking to sell the private equity, you can expect that the diligence process is going to be really thorough. They're going to want to understand what the true picture of the company is today, what moats there are, and then how they can create value, during that whole period. All right, going to the next slide. So Sri already discussed, some of these valuation methodologies in depth. So, I'll just touch on a couple, right? The comps, they're going to benchmark you against similar companies, whether it's public or on recent deals. Depending on the situation, there'll be a premium or a discount, right? If you're a $100 million jewelry company, you're not going to trade the same way as Richemont or Pandora. Just with DCF, I'll just remind people that small differences in the assumptions can make really big differences in the valuation. Some of the parts looks at the business in sort of separate segments, right? So it's more common in larger companies, but if you do have sort of distinct business segments, a buyer may take that into consideration. A liquidation analysis tends to be more common if you're looking at distressed assets, and effectively it's the net cash that would be generated if you sold all your assets and paid off all the liabilities today. It's generally a worst case scenario, so hopefully you're not there, but just something to keep in mind. Next page. So, private equity buyers are looking at the valuation of your company today, but they want to understand what happens in the future in various states of the world, right? If they make the investment. So a couple of things on that. A buyer is going to make adjustments to normalize your Ebitda so that it more accurately reflects the business post-sale. For example, if CEO salaries have historically been understated, or if you've been underpaying for cybersecurity, or if there's a lease that's going to revert to market rates once the deal closes. So as you're thinking through valuation, be aware of those potential adjustments, because I think it's really important that you have sort of what I like to think of as an honest view of Ebitda. And then buyers are also going to look at various scenarios, base case, upside, downside. So you need to have a defensible bottoms-up business plan and think through those other scenarios before you launch a process. So a buyer is going to create a downside scenario, right? And ideally underwrite to that. And remember that the person that you're speaking with has to also get approval from their internal investment committee. So to the extent you can make their job a little bit easier, right, and help them with that, that's always helpful. Next page. So the drivers in the middle of the page, right, that Sri was talking about earlier, that's what really is going to create equity value for shareholders. But I just want to touch on a couple of the factors. These are going to be different for different companies, but I'll touch on those on the outside. That's going to impact those. For e-com companies, right? Like Dan talked about this earlier, right? Buyers are going to be looking at your core metrics such as your LTV to CAC, cohort analysis, consumer engagement, retention rates, right? And demonstrating that strong community or recurring revenue is terrific because it enhances your retention and effectively lowers your acquisition costs and increases your margins. Think about your brand, right? It's what your customers say about you. And buyers will think through what else can be done with it, right? Whether that's new channels, new geographies, new categories, right? Does it have the potential to be taken offline? I will, issue a quick word of caution about diversifying your revenue, right? You want to think carefully through that if you're considering a private equity deal. I would, probably not go out and try a bunch of new, revenue channels in anticipation of a deal. I think it's better to have thought through a strategy, be able to articulate it, and then say to a potential buyer, hey, this is something we could do together, right? I don't think you want to do it halfway because you run the risk of diluting your brand. And there are certain actions that are hard to walk back, right? Like we opened at Target, but it crushed our margins. Or, we opened on Amazon and now we've trained our customer to not go to our website, right? So as you're thinking about those actions, just be wary of things that might potentially dilute the brand. You're talking about management for a second, right? If the founder's staying on, I think that's important that there's an openness on behalf of the team, right? As I referenced earlier, this is like a marriage, right? And there's going to be a bit of a shift in mindset once there's a PE owner in place. And some firms will really want to understand, if the founder is coachable or if they're open to, different ideas, right? Changes in the management team as the company grows. And then on the IP, right, you're going to see high multiples if you've got proprietary or patented products. Again, it's sort of, it's a little bit of a, it's a moat, and it is helps protect your downside, right? And on just the last page, I just want to quickly touch on preparation, right? If you're considering an exit in the next 12 or so months, start working now, right, with an advisor to get your house in order, whether that's Fortia, someone else, and that includes getting your financials, your narrative around your growth plan. You can expect that there's going to be a quality of earnings, right, around your, around your numbers from an accounting firm. There's going to be a legal review. You may want to consider engaging a firm to do vendor due diligence. That's more common, I think, in Europe, but it's becoming more commonplace in the US. So it adds costs up front, but it shortcuts the process once you're speaking with people. It also helps you as a seller unearth any potential issues so that you can deal with that ahead of time. So if you are going out, be prepared, good luck, and I hope that was helpful. Thanks.
Thank you, Stephanie. Yeah, we are big believers in preparation as well, which is why we have a specific exit ready program for e-commerce entrepreneurs. You can never start early enough. And big companies on Wall Street doing big M&A start at least 1 to 2 years out. Why shouldn't smaller e-commerce type companies as well? Thank you for that, Stephanie. Now I'd like to welcome Scott to the floor. Are you there, Scott? Please unmute yourself and over to you.
There we go. Hi, can everybody hear me okay?
Yeah, go for it.
All right, thanks for having me, everyone. And Stephanie, I actually want to pick up on a point that you just made around the vendor and buy-side due diligence. That's what I do for a living here. And we are certainly seeing that the standard vendor diligence in Europe is starting to become more prevalent here in the US. The rules about what you need, why you have to do it in Europe are different, but it's definitely proving to be more interesting, especially e-commerce, because there are important dynamics that need to be explained to a lot of businesses that a VDD will help with. But that said, what I want to talk about briefly is something that we do at PwC, which is, we call it digital diligence. So if you could advance to the next slide. One more. So to properly value the asset, we see it, and this is somewhat generic, but it's really important when you're looking specifically at e-commerce. So if you go clockwise from here, search win, customer analytics, digital marketing efficiency, looking at search optimization, the marketing tech stack evaluation, conversion funnel, Amazon, and increasingly other third-party marketplaces. These are all things that historically haven't been done in a proper commercial diligence to make sure you're valuing the asset correctly. It's typically been heavily focused on market size and growth and a little bit on digital marketing efficiency, but we're seeing that there's this gap that we're spending a lot of time with private equity investors to try to close. So if you go to the next page, when you think about how historically a private equity investor would value one of these businesses, left side is standard commercial diligence. That's just, you certainly, it would be irresponsible to try to buy a business without doing the stuff on the left. You also wouldn't be able to get any form of debt financing without it. And similarly on the right. But what we've seen, particularly in e-commerce, is that there's this gap between what would be considered traditional digital commercial diligence and then tech diligence, because the tech diligence more frequently than not is done, it's a little old school. Okay, it's not looking at how the software gets used to drive the business. It's very much back end. And so we started about a year ago responding to this need and digging in much deeper on customer acquisition, market dynamics, now the customer journey and how they're investing in marketing, because marketing marketing is historically seen when you're valuing an e-commerce business as a media spend. And it's the, well, we spend this much on advertising, what's our return on ad spend? And therefore, is it a good or bad investment? And that misses maybe 80% of it. And that's, now we're seeing that's changing how these e-commerce businesses get value. And also, and are we going to do questions while I'm talking, or do you want me to just go through and keep having them slide?
Keep going, please, Scott. We'll have Q&A at the end after your talk.
Excellent. Let's go to the next page. So these are some examples, and hopefully for the investors on the call, some of these may ring true. A few of these are all real world quotes. If you've ever done renovations on a house, if you know when you open up the walls and start ripping things out, that's the time to make changes. Once the walls are sealed up, it's a real nightmare to try to make additional investments. And that's what we see over and over again in terms of how you need to value these businesses correctly. We hear all the time, we closed 90 days ago, and now you're telling me that we have to replace this homegrown marketing tech stack. We didn't value this business correctly. We overpaid. Understanding where Amazon is going to come at you is really, really important. And then this Google search algorithm. One of the crucial metrics is cost of customer acquisition when you're valuing an e-commerce business. And if you're not looking at this business around the amount of paid as well as organic or free traffic, you're not getting the full picture, and you can end up having your cost of customer acquisition skyrocket without understanding why. Let's go to the next page. So these are some of the key issues that we get asked a lot, and that we see thoughtful investors wanting to get to the bottom of. So the obvious piece of the size of the TAM and SAM, market drivers, that's pretty generic, but important to do. The next one's very important, which is the search win rate. Because targets often will define their competitive set too narrowly. And you need to go look into how Google is ranking this company's pages to truly understand how much market share they have, and also who their competitors are. An example, we were reviewing the competitive set, and the management said, this is who we compete with, and we did some basic outside-in analysis, and we're like, yeah, that seems pretty reasonable. And then we took apart what their search results were. And what we found was that they actually had like 10 other competitors, people they'd never thought of. And that's very important between both organic and paid. Amazon is a huge issue here, both in terms of, are you a first-party distributor through Amazon? Are you third-party distributor through Amazon? And is Amazon likely to enter the category with an Amazon Basics offering? So that's two businesses that traded that we worked on. This is a huge issue. One was called, they're in around like industrial supplies. So this is not just B2C retail stuff. This is industrial supplies for construction site equipment or auto dealers. Next page. The customer analytics, the churn rate of customers, oftentimes what you find is in even in a larger business, especially one that's been rolled together through acquisitions, is that they don't have a single view of the customer. And so it's not, sometimes you ask these questions and they can't even be answered. And that's where you then have the light bulb go off and says, all right, I'm going to have to put some more investment behind this, and I have to back that out of my valuation. That's another X million dollars of software and Y million dollars of people that I'm going to need to underwrite over the life of this investment. I want to skip ahead one more slide, just in the essence of time. The marketing tech stack is very important, because what you see frequently, and it fits into proper valuation, is that the company will always, when they're selling, tell you they have a world-class marketing tech stack. And the reality is most companies have some form of a best practice marketing tech stack, but rarely are they world-class. Or if they are world-class, they have certain things they do quite well and others that they don't do well at all. So they might be excellent at customer acquisition, but they're very poor at retention. And the reason often is that they don't have the people or the software to do it correctly. And then the last piece that factors in a great deal, and you know, my background, I started in this space a couple million years ago in publishing, and ran a business that survived entirely on search engine optimization. And I think thoughtful investors will understand the search optimization, the organic free traffic, in parallel with the paid traffic, because the consumer, and put yourself in the buyer's shoes, you go into Google and you get a set of search results. The ads are always at the top, but the organic is still in view. And oftentimes, if there's not a lot of competition, those organic search results will perform extremely well. Next slide. So this is an example of the post-close value creation plan. And this is crucial for when you're valuing this, because this is the kind of thing that we'll put together for investment committee, so that these data get factored into the model. And so you can have a very clear understanding of what you need to underwrite and how long it's going to take to pay back. Because these are often considerations in a private equity hold period. If you're talking things that are going to be very hard and could take years, it may not be the right answer, because you're just not going to own the company long enough. I apologize for the formatting, it's a little clunky. I think that's it. Next page. That's it. I think I mean, in terms of sales pitch, happy to work with you guys, but I think I hit the top of the waves there, and I think Q&A is going to be more interesting. So Emmett, back to you.
Thank you, Scott, for those insights. And yeah, we can get into some of your solutions maybe as part of the Q&A or as a follow-up. But
yeah, I'm happy to do that.
Great to see the level of detail that you guys are looking at. Great. Okay, so if I can ask all the panelists to turn their cameras on and we can jump into questions. So again, please submit questions via the Q&A button. I will chat for the next 25 or 30 minutes or so. I will kick off by looking at some of the questions we've had in already, some of which have been answered by the panelists as we've been going. The first question was, the aggregators are pretty well known and publicized. What are some examples of PE firms that are buying e-commerce companies? What are some of the names? I responded saying that there's about 100 FBA aggregators. There's about 25 DTC aggregators. There are several hundred PE firms that will take a look at e-commerce, small, mid-size e-commerce brands. Some are specialists, some are category agnostic. There's too many to list here, but if any of the other panelists wanted to comment on this and maybe list some specific names, that would be great.
Well, I can share a couple that we've worked with recently that were sellers. So HIG is a good example. I mean, this is of all shapes and sizes here.
Yeah.
So if you look at some of the big trades that we've worked on recently, so Nutrafol, which was a hair care business that traded to Unilever, but they were founder backed. A lot of big private equity funds were in and around that deal. SmartSign was something that, as well as Digital Room. So these are assets, and if you look at who the winners of those auctions were, that'll give you a good sense. And you'll also be able, if you look at their peer set, these were all very competitive processes, and so there's no shortage of private equity funds that are chasing this space.
Great, thank you, Scott.
Yeah, a couple of the ones that we've worked with are Kainos Capital and Provenance Digital, but there's a number of others as well.
Thank you. Why are Ebitdas in Europe lower than in the US? I have strong views on that. I've been doing investment banking since the year 2000, and when we talked about clients coming to the stock exchange, we analyzed for years the difference valuations between the London Stock Exchange or other European exchanges and NASDAQ or NYSE, New York Stock Exchange, and there's always been a delta in valuation, always. And that's at the listed end, the big listed end. I think it's fair to say that in the seed and VC end, because there's more of an ecosystem in the States, is probably also a delta in that investors in the States will pay higher multiples for interesting growth businesses compared to folks here where I am today in London. That's my view based on what I've observed for 23 years, but interested to hear the views of some of my panelists on that one.
That's this is me being the curmudgeon stat PhD, but when I see 11.9 versus 12.2, I just can't imagine that's statistically significant. But I think you could be absolutely right that over time the average delta between the two is. But certainly, I mean, I know when you kind of move further back in the process to the venture stage, it's very well known that people who raise headquartered in San Francisco, they're getting higher valuations than the equivalent business that's raising in Atlanta. So I think those sorts of regional differences are well known and definitely there.
It could also just be related to, I think, just naturally the market that kind of US based or European based companies tend to focus on. For some categories, there's a higher SAM, higher serviceable market here in the US that could be part of it.
Yeah. Question: What is a good EBITDA margin for a $10 million revenue business? My response was, for FBA buyers right now need to see at least 20% net margins for that level, that size of business, and for DTC 15%. Any other comments around that, panelists?
Sounds fair.
Obviously, as the revenue scales, towards 100 million, then there's more flexibility on net margins. It gets harder and harder, but I think for 10 million specifically, right now, most of the buyers we speak to are looking for 20% net margins. Will the deck be available? Yes, absolutely. This deck, the recording, is made available to all attendees and those that can't attend. The videos are all on our YouTube channel of all our webinars we do. So please subscribe to that if that's helpful for you if you're interested in the space. A question from a beauty-focused entrepreneur and investor. How do you feel about acquiring a business brand that operates in another country? What are the risks and implications? In this case, she's talking about a business in Canada. Stephanie, do you want to kick off there? Maybe giving you a response to that, please.
Yeah, I mean, I don't think, some funds will obviously have a mandate that they're allowed to invest in certain geographies, right? If Canada's not on that list, then that's going to be an issue. But I think as long as the sort of regulatory, environment can be relatively easily understood, I think if you're looking at maybe not Canada versus the US, but
right,
in other geographies, are there certain customer differences that are going to make a difference in how your business is sort of takes off? That's going to be something a buyer wants to understand. But I don't think it's a deal breaker or anything like that you're in Canada.
Yeah, I think the size of the ocean between where you are and where the company is and where you're trying to expand is directly proportional to the complexity. Canada to the US, pretty straightforward.
Yeah. Very good. Some questions on valuation. Does the valuation approach differ for e-com products, such as an Amazon product or brand, versus e-com for services, such as Fiverr? I think the answer is, absolutely yes.
Yeah.
Would anyone else like to build on that, please?
I mean, the method to do the analysis is the same, but because the margin profile of the business is different, then the multiples just will always be different because they are really different businesses.
Yeah, the multiple for services are typically, I think I've seen multiples go as high as 20-25 EBITDA if it's or even higher if it's a pure services business. Product business is obviously much lower.
Yep.
Yeah.
It all ties back to the margin profile, Scott, as you mentioned.
Unless
and the potential for repeat business, just oftentimes if it is services and maybe you lean more B2B, you'll more often see much stronger revenue retention than if you're selling some cool gizmo to consumers.
And I think it's worth pointing out like the buyers we speak to are looking for brands, not products. Products are not valued very highly at all because ultimately they'll end up competing with the Chinese. There'll be a race to the bottom in terms of net margins. But brands that have high recurring revenue, either DTC or subscribe and save on Amazon, we know a few businesses that are 100% recurring revenue brands, and in that case you can get substantially high or relatively high valuations compared to just a transactional fee structure.
I think it also depends on the sort of how complex is your supply chain on whatever product it is that you're making, right? If it's a brand, yes, terrific, recurring revenue, terrific. If you have, if you're creating a product, where can things go wrong? Like what's complex? It could also be, it also can be an advantage for you, right? If you do that really well, if you do logistics really well, then that's going to be a huge value add.
And I think one of the other valuation is always this mix of what am I underwriting versus what's the option value that I'm buying into. Mm-hmm. And if you have a business that has a strong indication that it could move to some type of a recurring model as an option value, that will drive valuations up.
Yeah.
And oftentimes that, between buyer and seller, the seller will say, oh gosh, we're going to launch a subscription. We'll be the next Amazon, subscribe and save. And then your job on the buy side is to ascertain if that's accurate or not, how accurate that is.
Yeah. Maybe a question for each of you then, just given the tough economic environment we're in, are you seeing that that'll increase the incoming inbounds and interest from private equity for e-commerce brands, or do you think they'll continue to increase or reserve their dry powder on the sidelines?
My view is that I've actually seen that some deals that were overpriced just about 6 months, 8 months back are coming back to market at more reasonable valuation multiples. So I do think that there's also interest, and that triggers interest back from the PE to start taking a second look at deals. And there's also PEs that they have so much dry powder sitting, nowhere to deploy, that they're actually cutting equity checks instead of doing debt-based deals. So I'm very surprised they're going from 25-30%. I've seen talk of going 60-70% equity in transactions as the cost of debt goes up, and they have a lot of equity sitting on their capital to deploy. So I think both of those are actually favorable indicators for buyer PE interest.
Thank you, Sri.
Yeah, there was an article, and I think it was in Bloomberg yesterday, specifically about that. I think the title was "Taking the L Out of the LBO."
Love it. Brilliant. Daniel, Stephanie, any thoughts?
No, I echo what the others were saying. I think, because of the higher interest rate environment, you're going to see that level of leverage come down. And as a result, or as part of that, you're going to see the lower valuation. So I think as long as sellers are sort of realistic, then I think deals will get done. I think on the exits, it might be, that's trickier, right? And I think there'll be an imbalance between sort of buying and selling for a little while yet.
Yeah, I think that's all consistent with what we've been seeing too. Valuations are definitely more sane right now. So I think that was one of the key takeaways of the presentation and some of the private engagements that we've been working with other PE firms on.
So final question to each of you then. What's your top piece of advice for e-commerce entrepreneurs as they think about exiting, and specifically as they think about trying to gear up an exit to a private equity firm to just focus on that type of category of buyer? Who'd like to go first? Stephanie, ladies first.
Yeah, I think like my more kind of the top is simply start by being prepared and ready. It's like you don't have to do a whole lot. You don't have to spend months and months preparing a data room, but at the least get your financials in order, get your story straight, start thinking about how you're going to position. Just do the tip of the iceberg at least before you start trying to get PE interest, because if you do get traction, they'll want you to move quickly, and you want to be as ready as you can before you start.
Yeah, I think that's right. And, it's been said a million times, but really do be thinking about that, cash is king kind of, what does your true EBITDA look like? And also, thinking through those downside scenarios that I was referencing before, and kind of, just be really honest about what the company looks like today, and be sort of, measured, I think, in terms of, the business plan and so on.
Mm-hmm. Yeah, agreed. Scott or Dan?
Go ahead, Dan.
Yeah, I think in general, I would err on the side of being a bit conservative in terms of, kind of, this is to Stephanie's point. I think that there could be some risk on the downside. So if you are one of those very fast growing but money losing companies, I think they're kind of in the trickiest position, because they may actually have very good variable economics, where when they deploy capital to acquire customers, the incremental profitability of those customers is good, but it could be that because they're still kind of early, that their overhead is dragging overall profitability down into the negative. And I think, for that sort of a business, there's real value there, but you really want to be careful that you don't, end up getting stuck in a liquidity crisis that ends up snagging you, prevents you from getting the working capital that you need to, be able to buy your inventory and all the rest of it. So, being realistic to conservative, I think, is, probably advisable.
Yeah. And so, thank you. I'll go last. It's a trick from business school. So I'm going to agree with what everybody else said. And as a former entrepreneur, look, the first thing they teach you in business school is never run out of cash. Second is manage your supply chain, obviously. I would say have an answer for the obvious questions that your private equity buyers are going to buy, and have a very close relationship with your bankers. Don't outsource it to them. You're going to have to write, you as the entrepreneur will have to write that SIM. You have to own it. And in particular, have an answer for Amazon, the Amazon question. And if you, and just tell the truth, because the private equity people they're really looking at this in terms of how they can invest in your business to grow it. And I this question about management team. If you want to stay with the business, they're interviewing you and your team as much as they're diligencing the business. I can't tell you how many times I've seen situations where I have to get on the phone with the client and off the record be like, look, the numbers say X, Y, and Z, but I don't think this management team is going to get you there. And you will increasingly see private equity funds. They have there's an entire industry that just does the HR stuff to see if this management team is going to scale and what their strengths and weaknesses are. Yeah. Great point. In the end, business is all about people. Except e-commerce is easy, except for the people and the computers. Yeah, love it. Guys, thank you all for participating today. Really interesting conversation. I hope we've helped the audience think about how private equity look at companies, and specifically the e-commerce sector. They're more familiar with how aggregators look at it. So hopefully this was enlightening, and they enjoy both the live session today and the recording. And clearly this content will be valuable over the next year. So I really appreciate you guys participating today, and wish everyone a lovely day. Thank you. Thanks all. Have a great weekend. Bye-bye.
Cheers.